And so now we get to step number 5 in our 6-step process. And this step is to identify the pre-market conditions that increase the likelihood of having a trend day. Now, if you remember, we mentioned earlier the R strategy, which has an edge in the market, is to fade key reference areas on non-trend days and to try to get on board the trend on trend day. So it would make a lot of sense to have some good ways of identifying when we're likely to have a trend day, because that's the real determinant of how we're going to trade. Okay, if it's a trend day, we're going to go with it. If it's not a trend day, we're going to go against the moves at the key reference areas. And so the good thing is that there are certain conditions that increase the odds of having a trend day. And these are conditions that you can identify before the market opens. So that gives you an edge in itself because you'll be ready. All right, there's also other conditions after the market opens, and we'll get into those when we get into tactics. But there are certain conditions before the market opens that can help you in preparing your trading plan, which is what we're trying to do with this whole 6-step process anyway. Okay? Now, in our own trading and over the years of experience, we found 5 major conditions that if they exist, you have a higher chance of having a trend day. It's never certainty, but again, it's always about probability, so we just want to increase the odds of something happening. And so let's get into them. Condition number 1 is that simply we have a mature balance. This is probably the most powerful factor in giving us trend days. When we have a mature balance and we break out of it, those often turn into trend days. Those breakouts usually give us nice trending moves on the particular day of the breakout. Okay? Now, the question is, what constitutes mature? Well, in reality, it depends on your time frame, but when we're looking at trend days, you need to really see a balance area of at least 2 days, preferably 3 or more, all right? And if you have 2 days that are going sideways, and now you're about to enter the next day, and you break out of this sideways action of this balance area, you could get a trending move, or at least the odds are higher to get a trending move on that breakout. Now, the longer or more mature the balance, the higher the odds of a trend, and a bigger trend at that. So let's jump into the charts and see if in our current market prep we have this condition satisfied, and we'll also see some other examples of different types of balances. All right, so here we are back to our live market example. And of course, as we see, and if you remember, as we've talked about before, we do have a balance area, and it is a pretty mature one. Here it is, right? With these 4 days. And now, why do we know that this is mature? Well, and this will take a little experience in just gauging the charts. But when you're on a low time frame like this and you're looking at a 5-minute chart and you have 4 days in a row all kind of sideways, this doesn't last forever, right? And they're sideways in a pretty narrow range. It's almost like a rectangle, right? Well, sooner or later something's got to give when we're going to have an upside or a downside breakout. And when that happens, it'll most likely, unless it happens, in the overnight session, we just have a major gap or something, it'll most likely create a trend day out of it one way or the other. So in our current live market example, we do have this first condition met. And now as we enter the next trading day, we got to be aware that the odds are higher to have a trend day one way or the other, depending on where this thing breaks out. Now, does it have to break out? No, it could spend yet another day or two or more sideways. But the longer this lasts, the more mature it gets, and the higher the odds get of an eventual breakout. Okay? Now, like I said, the minimum is a 2-day balance. All right? And sometimes a 2-day balance is mature if it's coming in the context of a strong enough trend. All right? Now, assuming the larger big picture trend was down, okay, and we were balancing and now we just broke down real hard, and now we put in a 2-day balance, that might be all the rest that the market needs before it keeps going down if it's in a strong bigger picture trend, right? And so 2 days of sideways movement can be mature enough in that context. In this particular context, this down move is just an intermediate term downtrend in the bigger picture uptrend, and it's not something massive, and it's slamming right into major key reference. So the likelihood of just having 2 days and then keep moving is a little lower, right? So we expected basically more of sideways movement to last longer here. All right. But you don't only look for mature balances on, the last few days. You look and see, well, am I in a bigger, potentially mature balance? And let me give you an example. All right, so I've zoomed it out to a 15-minute chart, and I've kind of scrolled back into the chart a bit, a few days. And I scroll back to this large balance area that we've talked about in the last few sessions. All right, and this is where the gap down happened to cause, this move down here, right? Okay, so if we were now trading here and we were about to enter the next day, we were preparing for the next day, right? Now forget what actually happened. Let's just assume you were here and you didn't know what was going to happen next. Well, you would have to note that you've been in about a month and a half almost big balance area, right? And then you'd have to note that this thing's getting pretty mature. A month and a half of relatively sideways movement where we had, 3 tests of the upper end and now 3 tests of the lower end is getting mature in itself on the bigger time frame. Okay, so you would also have this potential condition. Now here it's a little different because given the fact that it's such a big area that's spanning so many days, it's harder to time which day is actually going to take you out of it. For all we know, this thing could then trend up and spend another 10 days in this thing. So it's harder. But we're aware of it. We're aware of the fact that given that we're in a big balance and we're now on one extreme of it, right? If we were right in the middle of it, the odds of having a trend day is not increased because anything can happen there in the middle. But as we are in a mature big balance and we're in one extreme or the other, then we got to be ready for the potential breakout one way or the other. Okay? And that increases the odds of a trending day. All right? So that's how you look at it when it's a big balance. You look, are we at one extreme or the other of the one potentially about to break out? When you're in one like this, this smaller one that we were just talking about now, well, then anywhere you are in it is close to the extreme because it's not that big. So at that point, you're in a 4-day one and you could expect to move out of it at any day. All right, so that's just how you look at it. And knowing where you are, that we have a mature balance of any size around, at least 2 days and up, gives us higher odds of a potential trend day, and we just mark that down as one thing to keep in the back of our minds. Okay, one thing to weigh decisions with. All right? We're not looking at it on its own, but we put it on the list. All right? And given that, let's go to the second condition. And that second condition is volatility contraction. Now, what does this mean? Well, think of it this way. If you have a coil and you compress it really tight and then you let go of it, what happens? Well, if you've compressed it really tight, when you let go of it, it's going to expand quickly. All right? It's the same way in the market. When the market is compressed really tight, i.e. there's a contraction of volatility, you have like very narrow range and very tight movement within a range, this increases the odds that we're going to get an expansion one way or the other. Now, of course, this is related to condition number one, because in essence, what is a mature balance? Well, it really represents a sort of volatility contraction for that particular time frame where prices stay in a narrow range, right? But what I'm talking about here is on the level of 1 day, okay? And in particular, I'm talking about a concept called NR4 or NR7. Now, what does NR mean? Well, NR means narrow range, okay? So NR4 means that the latest day in the market had the smallest range of the last 4 days. And NR7 means that the last day prior to the one we're about to trade had the narrowest range out of the last 7 trading days. Now, these particular terms, NR4 and NR7, narrow range day 4 and narrow range day 7, these were termed by a man named Toby Crable in a seminal book that he wrote, which is now, I think, selling for hundreds of dollars, and it's in very rare print. But basically what he did was he did a massive historical analysis, and he found that if you have a day that is the narrowest range day out of the last 4 days or out of the last 7 days, you usually got nice trending moves out of that. After this compression of volatility, something would expand and you'd get a nice trend day. Now, not all the time, but the odds of having a trend day after an NR4 or an NR7 is higher. Now, my own trading, I never like to be too specific about anything. For instance, why not NR5 or NR6? In my mind, of course those are the same. It doesn't really matter if it's 4 or 7. So what I like to look at, okay, is anything that NR4 and up, the narrowest range day out of the last 4 days and up. Of course, the more the better. If you get an NR15, i.e. the narrowest range day out of the last 15 days, or an NR20 or whatever, that's even more of a compression right there. And the tighter that volatility contraction, the more the likelihood for a trending move out of it. Okay, so this is just another condition that you look at. You just look at the particular day and you compare it to the ranges of the last several days. Now there's a website called mypivots.com, and I'll provide you in the key takeaways with the web address. The good thing is that it gives you the Crable price patterns, as they're called, the Tony Crable price patterns. And the cool thing about that website, it's free, and you don't have to manually go and look back how narrow was this day compared to the last days and all that. It'll basically tell you if you have an NR4, NR7, NR5 day, and it'll actually tell you if you have more, how narrow it is, how many days back does it go. And it'll provide it for pretty much all the markets that you can trade. So it's a really good resource to have. And again, I'll provide it in the key takeaways for you. Now let me just jump into the charts and show you an example of this so you can just see it visually and see what it's like. Okay, do you remember in the session on drawing in all the key reference areas, at the end of that session, at the very end of that video, I showed this example where we had this day and then we tested the high volume node of it and then we broke down. And as I was telling you, you would have to have a good context to know that this was likely, right? Well, what was that context? This was a very narrow range day. Look how tight this range was. We had a high of 53.5 and a low of 47.5. That's only a 6-point range. By contrast, look at this range, about 15 points. This range is bigger. So is this one, this one, this one, this one. So, I'm willing to bet that that particular day was an NR10 plus, all right? So there was major volatility contraction here. And that raised the odds that we could see a trending move out of it. Now, it doesn't mean it has to happen, but in this instance, when we dropped down and then came back to retest the high volume node and failed and failed and failed, and we also had a really tight volatility contraction in the morning itself, knowing that this was an NR, 10, 15 or whatever it was, told us, hey, there's a decent chance that we could get a breakout move one way or the other. And in this instance, it was telling us it was likely to be down because this high volume node was holding. So if you were selling here, this kind of move is not completely unexpected. You could actually have a good idea that there could be something when you get this kind of NR day. Okay, so that's just another thing for your toolbox, another condition that could tell you that we could get a trending move. All right, I've personally used this one concept in the gold market and made a killing with it over and over, just with this one concept. So it depends on the market, but it can prove quite powerful, especially when you add it with other stuff. You never want to do it completely alone without context, but when you add it with other stuff, it can be very powerful. So having said that, let's go to condition number 3. And condition number 3 is a large gap through a key reference area or areas. Okay? Now when you gap right through some major key reference areas, this means that you're rejecting them. Okay, this means that either the buyers or the sellers are completely rejecting that area and looking to move to a new area to establish value. And often with such a gap, what you get is different players caught on the wrong side of the market opens in that large gap. All those people that were caught on the wrong side have to cover their positions. That pushes it further. Then the momentum players come in, and often you can get a nice trending day out of such a gap. Okay, so this is a great one to keep note of too. And let's take a look at an example to show you what it's all about. Okay, this is a good example. As you see here, we had a bunch of days, down, up, down, all over the place. No real pattern to it per se. Okay, but then the next day, what happened? We gapped up right here. All right, and as we gapped up, not only did we gap right above this whole previous day's range and value area, but we pretty much gapped up right through everything, right through this high that had rejected prices and caused this big down move, and just above this whole area, above this whole range, above any key references that could be there. We just gapped right through all of it, right? And often what will happen in that case is, you can see the gap before the market opens, obviously. You know that a gap is coming, so this is a pre-market condition. And if you see something gapping through the previous day's value area, or right through the whole previous day's range, right away from it, especially if it's not only through the previous day's range, but through several days' ranges and value areas, the odds are higher that we could have a trend. And on this particular day, we trended higher. Right? So, we had a nice trending move up. So, it doesn't always work, but it increases the odds. Let me give you another example. Okay, I've moved to another period in the charts. Don't mind these lines. These lines are, for our current live market example, so they're staying around. But take a look at this, right? We see we have effectively a pretty big balance area right here, right? It's all over the place, it seems like it, but it's major lows that are identifiable and quite a few highs, and it's a balance area. And then we gap right here and we take off. All right, and this we'll get into when we get into tactics, what that means when you just take off right away like that. But look what a trend day we got, massive. Now there was a lot of other things lining up on this particular day, but the point is that when we gapped, we gapped through this day and this day and even right at this day. So we were gapping through the value areas of the last several days. We were gapping through these two highs. Let's go a little closer. See this reference area where we had this high, got rejected, again got rejected. We gapped right through that, right through the previous day's high, this whole range and this whole value area. That increased the odds that there is some significant market moving event or something happening in the overnight session, and that the big institutions would come in on this particular day because there was something changing the value perception. All right. And of course, when you open here, anyone who was short throughout these days, and in this case throughout that whole balance area, is going to be stuck on the wrong side. They're going to have to cover their shorts. They're going to be buying on the open. It's going to push it higher faster, and the momentum will take on a life of its own. So another thing to add to the checklist: is there a gap moving through some key reference areas, especially through the previous day's value area or the few days and whole range? Now, let me show you something just as a note of caution. Okay, I've zoomed forward back to our particular example of the live markets, and just a couple days before that, we had talked about this gap that had gapped down big and broken us out of the larger balance area. Now, there's two things you got to notice. Everything's contextual and it fits together. Nothing is on its own. You have a large gap, so you go, okay, the odds of a trend move are increased. But if you remember here, where were we gapping into? Well, we were gapping into that major support area. Okay, if you remember, I had removed the lines at 406, 407, but we were gapping right into that. That's one, so that will automatically then counter and decrease the odds of a trend move because the odds of bouncing from here are high. And two, this gap is massive. Okay, this is like an 18-point gap, which is usually bigger than the range of most days. Now, when big gaps are good, but when the gap is huge, sometimes what you'll get is just range bound action because the move will have happened in the overnight session and there'll almost be nothing more to give during the day session. So again, this will take a bit of experience of watching the markets, and you can look at historical charts and speed up your learning process to know what represents a huge gap, what represents just a normal big one, and all that. But suffice it to say that you want a big gap, and that increases the odds of a trending move happening. But if it's massive, like this particular one, sometimes that causes just sideways movement as we congest that huge move. And that'll be especially the case if we're gapping into some major support or resistance area. So that would counter the fact that the odds of trending are high. Okay, so keep that in mind. All right, and with that we get to condition number 4, which is market moving economic releases. Now, we've already discussed this extensively, so there's no need to go into it again. But the basic idea is that this condition applies for the specific day that you're about to trade. If there are some major economic announcements, that increases the odds that they could change the perception of value enough in market participants to cause a trending move up or down away from the current value area. All right? And if there are no major economic releases, and maybe later in the week there are some, your odds of having a trending move this particular day you're about to trade are lower. All right, so we've already discussed this, but this is just another thing to take note of as part of the conditions of potential trend and non-trend. All right, and then condition number 5 is whether we have a generally elevated volatility environment. Now, we also went deep into this regarding ATR, average true range. In the original training, we looked at implied volatility when that tells us too about the current volatility environment. We've also seen volume. So in general, this one's pretty easy to know if you're in it or not. If you've been having much higher than average volatility, much larger ranges, the market is making some sort of trending move, higher or lower, and usually you're going to get the much higher volatility environment in a down move because fear and panic are more powerful than greed. But basically what this tells you is that when you do have a generally elevated volatility environment, right, you're going to get on average more trend days. And when you have a low general volatility environment, you're going to have on average more of those slow choppy days. Okay, if you look back to, for instance, 2008, when we were having that major meltdown, and you actually did a study of how many trend days there were, you're going to find that there was a much higher percentage of trend days in 2008 than there was, for instance, in 2010. Okay? And in 2010, which was a lower volatility environment, there was many more range-bound choppy days on average, especially in the stock indices, as compared to 2008. So this is a bigger picture thing, but it doesn't have to be, a full year thing. It could be we have a couple weeks where you're having a big meltdown or something, and the odds of having trends and directional conviction during those times is higher. So this is, one of those conditions that you have that in the back of your mind going into any day. What kind of general environment are we in? All right? And with that, you'll basically have your 5 conditions that you check for. And the more of them that line up together, the higher the odds of a trend day. Okay? So for instance, the biggest odds of a trend day is if you have a mature balance, all right, and the latest day within that balance had a volatility contraction, it's an NR, whatever, 4 plus, and we're gapping in a major way through that in a breakout way, all right, and there's some economic release due that day, and it's a generally elevated volatility environment, well, if you have all those, the odds of having a trend day are very high. And then once you get into the tactics, once the market is open, there will be a few things that we're going to teach you to look for to confirm whether that's actually happening or not pretty early on. Okay? But this is all very good pre-market prep. And again, the more that line up, the better. And so with that, we will move to the final 6th step, which is to build scenarios for the day that basically form your trading plan based on all the first 5 steps that you've undergone. So we'll get into that in the next session.